Hi, today I wanted to share some information with you regarding purchasing a home, taking out a mortgage when you have student loan debt. I have many borrowers today that come to me and are very concerned because they have so much student loan debt, they won't be able to qualify for a mortgage. And the fact that you have student loan debt in and of itself does not mean you're not going to qualify for a mortgage. That's a very common misconception. The truth of the matter is, we as lenders, what we're looking at is what is your monthly payment on that student loan debt? Because that's what's going to get factored in to your overall, what we refer to as debt to income or DTI. And if you remember, debt to income has to do with what your monthly obligations are divided into your gross monthly income. So we are more focused on how it impacts your DTI than we are the fact that maybe you owe $75,000 on a student loan. It's not the amount of debt, it's not the balance owed, it's the monthly payment. Everything is around the monthly payment when it comes to qualifying for a mortgage. For example, you might owe $50,000 on a student loan, but your payment is only $150,000. The $150,000 is what's getting factored into all those calculations as far as debt to income is concerned, not the $50,000. That doesn't play into it whatsoever. And so with the new payment options that student loans have right now, you should be able to put yourself in a fairly good situation. And what I mean by that is there's a lot of income-based repayments that will factor in what your income is, what your balance is, etc., and come up with a monthly payment that oftentimes isn't too terrible. And in fact, in some cases, we've even seen where an income-based repayment will have a zero payment due as that calculation. And many loan programs will allow us to use that zero monthly payment as long as we can document it through the servicer of the student loan. In other words, get a statement showing that's your actual payment. Sometimes we have to verify that it's an income-based repayment and that's why it's at zero. But essentially, as long as we can document it and it shows that it's a zero payment, that's all we have to factor in. So that obviously has no impact on your debt to income. Sometimes, however, you might have student loans that are in deferment. And if they're in deferment, depending upon the type of financing you're doing, whether it's FHA, VA, Fannie Mae, Freddie Mac, they all have different calculations as to how we have to figure out that monthly payment. For example, FHA has us take 0.5% of the balance, and that's your monthly payment. So let's just say, for example, again, you had a $50,000 student loan, but it's in deferred status. That would work out to a $250 a month minimum payment we have to factor in. If you go into a repayment, take it out of deferment, put it in repayment, and maybe you get an income-based repayment, and now that payment is only $150 a month, we only have to use the $150 a month, not the $250 a month. So there are times when I'll actually advise clients, hey, take yourself out of deferment, go into repayment, especially if the repayment payment is going to be less than what I have to calculate for the deferred payment. Again, I hope that makes sense, but bottom line is it all comes down to what the monthly payment is, not so much what you owe. And then an additional concern or an additional myth, if you will, sometimes is that people think I'm going to have this larger down payment because I have all this student loan debt. Again, FHA, Fannie Mae, Freddie Mac, they all have programs that are geared towards first-time home buyers that will allow for FHA, for example, 3.5% down, conventional 3 to 5% down, and even better terms in terms of mortgage insurance, interest rates, etc., with their Home Ready, Home Possible program. So all of those things can factor in and put you in a better situation, even if you have a lot of student loan debt. Now, the one thing that is very important, however, with student loan debt is that you are making your payments in a timely fashion. I've had people say, because of all my student loan debt, it's hurt my credit score. theoretically, the only way it should really hurt your credit score too much is if you haven't been paying it. In other words, if you have been late in your payments and things of that nature. If you're making payments in a timely fashion, it should actually help your score and improve your score. So if that's the case, make sure that you are paying everything timely, keeping it up to date, etc. Now, there was a period of time last year where everything was on hold and you didn't have to make payments, and all of a sudden loans are going back into repayment, and some people were not following through and making those payments, and that impacted their score because now they're considered late on those student loans, not so much the fact that they just have the student loans. I hope you found this information helpful, and if you did, please do me a favor and subscribe to our page here. Also, feel free to forward this to any of your friends, family that might have student loan debt and might be thinking to themselves, with all this student loan debt, there's no way I can qualify for a mortgage. What I can tell you is, again, the most important thing, talk to a lender like ourselves. Let us go through your situation, figure out what you've got going on. Again, sometimes you might be in a deferred status on your student loans, and it might make sense for you to go into repayment if the monthly payment is going to be something that A, you can handle, and B, doesn't impact you as much as leaving it in a deferred status. All right, listen, you take care. If you need anything, call, text at any time. Have a great day. Talk to you soon. Bye-bye.